Hello, and welcome to another segment of ARA in Conversation, where we delve into the key issues impacting real estate investing in today's world. Joining me today is Sabrina Unger, our Managing Director of Research and Strategy, who's from New York, who's going to be engaging in a conversation with us about market segmentation and research. And what we want to do today is begin by talking about something near and dear to our heart as investors, is the identification of markets and the segmentation of those markets through your research and everything that you do. Why don't you begin by giving us an outline of how you think of that and when you're approaching real estate and research?
Yeah, absolutely. We've built out what I think is a really robust data-driven approach to identifying what we believe are the markets that have the best risk-adjusted return profiles. And so how we're doing that is really combining the key metrics that we think really drive that, both from a historical and projected perspective. So we're thinking about the big picture things like population growth, migration, employment drivers, and also getting down into the much more sort of granular fundamental perspective. So, what's happening with supply? What is the demand response? How is that feeding into, vacancy and rent growth? And how are all of those things coming together? And really, at the end of the day, how do we identify those metrics is, we're using a lot of technical tools. There are predictive analytics and algorithms and modeling, and we're using all of those things. But at the end of the day, it really comes back to basics, right? Which is what drives demand for real estate, and it's people and businesses.
Okay, so we talk about this in the investment committee about headwinds and tailwinds and what markets are going to be the appropriate ones to invest in. How do you differentiate between markets where there may be headwinds, which turn out to be just aberrational at that moment in time, and they maybe can't have tailwinds going forward, or the other way around? How do you think about that?
Yeah, I think it sort of sounds like maybe what you're outlining here is a little bit of either a top-down or bottom-up approach. And so I think having a holistic view of markets as we make our investments is really key. So if you're only thinking about the sort of big picture elements, if you're just focused on where is the population growth, migration, employment growth, you could miss some of these, more nuanced supply demand issues. But alternatively, if you only focus on the supply demand, then you're going to miss out on some of that growth. And so I think taking only one piece of that as a picture only half informed. So you really want to have a holistic view, and I'll use Austin as an example. It is certainly experiencing, from a bottom-up perspective, a softening in fundamentals because we have all-time high levels of supply being delivered into this market. We had high levels in 2023. 2024 will be another high year for deliveries. And so that might make some investors and some managers a little apprehensive about the market. But for us, when we think about market selection for our funds, it isn't just even on a 1 year or 2 year basis. We're really thinking about things from a 5-year perspective, 10-year perspective. And so that it's so that we're not unduly influenced by these short-term fluctuations and missing the forest for the trees. So again, coming back to Austin, do I think that it's going to be the number one performing market for rent growth in 2024? Probably not. It needs to work through the supply. But when I think about it from a 5-year perspective or a 10-year perspective, I still think our view is that Austin is a top 10 market because all of the things that drove the growth that we've seen over the last few years, so companies moving there, people wanting to be there, the lifestyle element, all of those things are still in place. And so I still think it's going to make that market one of the top. So you need to have both perspectives, holistic view, appropriate timeline, I think is really critical.
So when we sit in investment committee and we're talking about research about a particular market and we have these supply demand characteristics that we're always looking about, it seems that we can somewhat predict a level of demand, but what we don't have the visibility on is supply. How do you factor that into your thinking?
Yeah, so I think maybe it begs sort of pulling back the curtain a little bit on how we do our forecasting, and it does start with supply. So we have a fairly solid view of where we think supply is going to land in the first 3 years of our forecast period. And again, this varies a little bit by sector, but when you think about an office market we're going to forecast for, it takes years for those projects to get approved, especially now to get financing. It takes a long time to build them. They're very complicated projects in major markets. And so we have a lot of visibility and a much further timeline to be able to know. I know what buildings are likely to deliver in 2027 in New York because they will already have started construction. So we have a pretty firm outlook on supply for office. Apartments, again, we know the timeline, approximately how long it takes to build a building. We know when permits have been pulled. So we start to get a little firmer outlook. I think, honestly, what is the hardest sector to get supply right is industrial. And even though the timelines have extended considerably since COVID, just given the timeline to getting materials and labor and all these other things, in terms of the complexity of construction, they're less complex. And so they can be built up and you can have smaller buildings that maybe you aren't tracking. And so we do build in a degree of buffer into our supply. The demand function is really a multi-part input, which is thinking about what is our macro view. So do we think we're going to have a recession? Do we think our economy is going to be booming and office companies are going to start leasing more space? That will influence our view of demand. We're also going to look at historical patterns. So is there, something in the past in that market where the vacancy is comparable to where we think it's going to be today? What has been the corresponding demand response the next year, or the rent growth response? So we can look to historical patterns, but then say, well, something structurally is different in this market today, so we can't look to 2001 and think it's going to behave the same. And so that's really part of our forecasting process. And then also, again, building in effectively, scenario testing and buffers, because we know we're not going to get 100% of every supply to every square foot, right? And so we need to sort of anticipate what is the band of likely outcomes, and then we can make sort of our market and sub-market selection.
So as an investor, one of the things that we're charged with is managing risk. And risk is really fundamental to everything we're talking about. And research is very much part of that risk factor that we're trying to address. I mean, we can look at real estate and property level risk by doing due diligence and evaluating the parking lots, or evaluating the roof and the elevators, et cetera. But let's deal with some of the other risks that are out there, the exogenous risk we don't really talk about, political risk, economic risk, climate risk. How do you think about that in the context of evaluating your market segmentation?
Yeah, I think we can, sort of segment markets into categories based on the type of risk we want to profile. So, do we want to talk about what climate risk, how markets rank? Well, if you do just a climate lens, markets, in the middle of the country and Kentucky and Tennessee, those are going to screen well because they're not at risk. But we also have to balance that against growth risk, right? Neither do we want to go into the Rust Belt that maybe doesn't have as dynamic of growth. And so it's layering the lenses of risk and what is palatable and tolerable for us. And it's effectively, in very simplistic terms, is a Venn diagram of risk. What are the different risk categories? Which markets are exposed to what is sort of the bullseye of markets that seem to satisfy our risk tolerance, and then what sort of other risks are we willing to accept for a trade-off in return? And that's effectively how we incorporate that.
When you're talking about your screens that we go through, and we talk about this during investment committee, and you screen certain areas, certain metros and cities as being very positive for long-term growth, and certain other ones that are not, are there any areas that you sort of X out, and I don't want to use the word red line, but you want to mark it out, and you want to exit that area, or you don't want to invest there?
Yeah, I think if you're thinking about effectively exiting a market, it really comes down to a couple questions, which is, number one, is the environment I'm in today, because it arguably must be bad if you're thinking of leaving, is it sticky? Are the conditions that exist today likely to persist into the foreseeable future well throughout my hold period, such that it's better for me to cut my losses? So that would be maybe a reason that you would leave a market. Again, I think if you have a certain risk tolerance for climate or for rent control, but again, I don't know that it's necessarily so easy to redline a whole market. I think, again, there are always opportunities, whether it's, I don't want to be in New York because of the regulatory risk, I'll go to New Jersey, or I like Miami. South Beach is probably not for me, but maybe I'll go to Wynwood. I think that there are some sub-market lenses. And so in reality, I think it would be very difficult to completely exclude an entire market.
Well, terrific. Let me ask another question, which is what is going on today from your world? Research is now becoming very different than it was 20 years ago. It's much more sophisticated. The data that is available today is voluminous. How do you integrate that, and what are the things that we should be thinking as investors, and what should our investors be thinking about of how research is really going to drive overall returns?
Yeah, I think number one, and this is true for researchers, our investors, for everybody, think about the quality of the data that you're looking at and what does it represent. So if you get a report that says this market is X million square feet of industrial, compare it against other sources. There's not one definitive statement of what a certain market or geography should or shouldn't be. So compare and contrast, right? There's truth in the data to the extent that that provider has that perspective, and they only see a certain segment. So it's really about comparing what else is out there, not just accepting everything as truth. There's always a degree of implicit biases that can sometimes appear. And so being cognizant of that and asking the question of the data and of ourselves when we analyze it, what aren't I looking at? What data should be a part of this conversation that hasn't been, that isn't? Does it exist? How do I get it? And so I think it's asking these really holistic questions. Again, we have all these tools at our disposal, and the benefit of the United States as a market versus other global real estate markets is we have so much data, the depth and breadth of it, the amount of history we have, it's really unsurmounted in the rest of the world. But that can lead to analysis paralysis, where we're just trying to find one more data point to make our decision. And real estate is not a homogeneous asset class. You can have two office buildings on the same block right next to one another. And the reality is they're going to have very different profiles because of vintage, floor plates, tenants, amenities. And so data is just one piece of the puzzle. I still think you have to have boots on the ground. Real estate is a real asset.
So this is a great conversation, because we all know that research is fundamental to the selection of markets. And you've really got to be able to understand what those markets are going to do. Asset selection is very important. I agree with you. But the market is going to drive a lot of the factors. You can buy an office building in Death Valley, and it can be the best office building in the world, but if there's no demand, it isn't there.
Yeah.
So, well, Sabrina, thank you so much. I appreciate your time. This has been a great conversation, and we're going to continue this again.
Yeah, thank you.